Welcome all for our today GST session. This is our 85th session. Now, as you know, today we are going to discuss on GSTR-9 9C. As we know, 31st December for financial year 23-24 is the due date. So it's very important while filing our returns, annual return for 9 9C, we take care of all the. Stephen, can you mute all?
Yeah. Yeah, ma'am, you can proceed.
Fine. So, welcome all of you for today our GST session, which is basically concentrating on GSTR 9 and 9C. This time, this session we have divided into two parts. First part will be basically on focusing on what are the types of working you need to do before you initiate the filing of GSTR 9 and 9C. It plays a very important role because, as we all know, we are standing in the 8th year of GST from the introduction. And this is the 7th time we are going to file our 99C. But lot of notices has been issued. Investigation happened, audit happened. And what has been notices is most of the time, the reason for issue of notice or discrepancy were irregular reporting which were done in 1, 3B or 9 or 9C. Due to reporting error, even though taxes were correctly paid, has resulted into a number of notices. Second, even though maybe reporting may be correctly done based on what SSC felt it should be a taxable or exempted. But what has been noticed that even though they might be considering it to be an exempt or a non-GST supply, or they are considering it to be a non-taxable, or where they are considering that ITC to be an eligible, but though ineligible as per GST law. So this all checking, if done at the time of filing GSTR 99C, that this all are taken care before the any notice from department is received. So this is what our focus is been on, and this is what we have planned to do in two parts, where we will be focusing how you should ensure that your workings are in compliance with GST law, and any irregularity or any point or any dispute which you notice now that taxes not paid or not properly disclosed can be taken care while filing 99C. And in second part, we will be more focusing. The second part is going to be happened on coming Saturday, 7th December, where we will be more focusing how the details should be reported in GSTR 9 and 9C, which are the tables which are relevant and mandatory to be reported. If any error done while filing 1 or 3B, how those error, even though done while filing the monthly returns, can be taken care through GSTR 9 and 9C. So in this manner, we will be going ahead. As I said, today is just focusing on working. Okay. Now with this part, now it is important to understand what through this annual return department is looking forward. Their whole and sole purpose is to check that you are in compliance with law. When I say their whole purpose is to check whether you are in compliance with GST law, is to check whether tax as applicable has been paid or not. Now, how they will check whether the tax as applicable has been paid or not? So, so for that purpose, what they required? They required your turnover. When I say turnover, in that also they specifically require taxable turnover. So what they are looking is taxable turnover. Then how I will come to know at what rate you are paying the taxes. For that, we give HSN classification in our table 17 of GSTR-9. So from there also they will come to know. Even in GSTR-1, we are giving HSN classification. Plus, we are also giving our rate which is applicable based on the business we are into. So those all help them to understand what is the tax payable by you. The moment they decide what is the tax payable, now the second question which arises, how the tax has been paid, means how much has been paid using ITC and how much has been paid using cash. Cash, okay, it's a straightforward visible paid through DRC, through 3B or DRC 03. But the second part in ITC, again a second step of verification arises where they will check whether the ITC, which you are saying it to be eligible ITC or not. Just because you are claiming something reflecting in 2B, it doesn't mean you became eligible for it. You have to make sure you comply with section 16 and 17 in order to claim those ITC. Based on those based on those verification only, you will get the eligible ITC, and only the eligible ITC only you will be allowed to set off against your tax liability, determining your net tax payable. This is what the whole purpose or the whole thing they are trying to look at from GSTR 9 and 9C perspective. And this is what how you should do all this verification is what with me Hitesh is there who is going to take you through it. Hitesh, over to you.
Let's surround.
Thank you, ma'am.
1 minute. Participant, I will request you if you can mute yourself. Thank you.
I hope my screen is visible to everyone.
Yeah.
So in today's session, we will be discussing about the prerequisites for filing GSTR 9 and 9C. Firstly, we will be learning about who are the people on whom filing of 9 and 9C is compulsory, for whom it is optional, and for whom it is not required. Second perspective, we'll be looking at understanding of the financials and the business. And fourth, post that, we'll be coming to the prerequisites. Firstly, filing of annual return. It is governed by Section 44 of the CGST Act. Section 44 of the CGST Act requires every registered person. If you are registered under GST, then you are required to file file the annual return. But persons who come under the category of ISD, input service distributors, who are registered only for the purpose of deducting TDS under Section 51 or collecting TCS under Section 52, casual taxable person and non-resident taxable person, they will not be required to file an annual return. Annual return needs to be filed within the due date prescribed in the law. The due date prescribed is 31st December of the year. At 31st December at the end of the years, at the end of the financial year. If it is for 23-24, then the due date for filing the annual return is 31st December 2024. The forms prescribed for filing of annual returns. Annual return for registered person, the form prescribed is GSTR-9. For composition dealer who opts for paying tax at lower rates under the composition scheme, the form prescribed is GSTR-9A, but as of now, it is not available on portal. So form GSTR-4 will be used for filing annual return of composite dealers. For persons who have taken registration for the purpose of collecting TCS, GSTR-9B is the form prescribed, but this is not yet activated on the portal. And for casual taxable person, non-resident taxable person, ISD, and persons deducting TDS under Section 51, the annual return is still not applicable. The threshold limit for filing the annual return. the threshold limit, if your aggregate turnover is not exceeding 2 crores during the financial year. With regard to aggregate turnover will be considered PAN based and not GSTR based. Further, aggregate turnover will include all components as defined under Section 2, subsection 6 of the GST Act. If your aggregate annual turnover does not exceed rupees 2 crores, then the filing of GSTR-9 is optional. If your aggregate annual turnover is in between is more than 2 crores but is less than 5 crores, then you are mandatorily required to file your GSTR-9, but filing of GSTR-9C becomes optional. Again, if your aggregate turnover exceeds 5 crores, then both GSTR-9 and 9C filing becomes mandatory. One important thing to note here is that suppose your turnover from sale of goods is coming to around 1 crore 95 lakhs, but you have interest income pertaining to interest from deposits, fixed deposits to 10 lakhs. Then for the purpose of computing aggregate turnover, since it has crossed 2 crores, you are required to file your annual return compulsorily. Similarly, if in case your turnover from sale of goods or services, whichever business you are engaged into, is rupees 4 crore 80 lakhs or 4 crore 85 lakhs to be precise, and your interest income exceeds rupees 15 lakhs during the year, then also you will be required to compulsorily file GSTR 9 and 9C.
Hitesh, can you just go back to the previous slide?
Yes, sir.
Friends, couple of things one needs to know here. Generally, every business is expanding and there would be 1 or 2 registrations that would be there. There is always a thinking that, okay, the limit which is 2 crores, 5 crores is applicable, and there is a head office, the head office accountant knows that, okay, yeah, this is a PAN-based turnover, and they do the filing. Today, there are a lot of decentralized accounting that happens. The accountants at the remote locations might not be aware of the provisions. As Hitesh said, the turnover has to be seen qua entity and not qua GST and ID. For example, let's say a business unit having head office in Hyderabad, Bangalore, Chennai, Bombay, each of these units are doing 2 crores turnover, which itself is 8 crores. All the unit accountants are filing the respective annual returns. So the annual return is GSTN wise, each GSTN they have to file. Assuming there is 1 unit in Assam, 1 unit in Rajasthan, which is doing say 5 lakhs and 10 lakhs turnover, we just newly started. Even those units also have to file the annual return. If you do not file the annual return, there are penal consequences which we will deal at the end. Ensuring all the GSTINs in the PAN filing the annual return is must. This is one common mistake that happens. If someone is doing on behalf of a tax practitioner is doing for others, this is something that you need to advise. This is one important you need to be aware of in this slide. Second, when we say the GSTR-9 is optional, where aggregate turnover is not exceeding 2 crores, even though it is optional, it's always recommended that you exercise the option of filing the returns. But what happens when someone says it is optional? Today on the portal, you can actually log into your dashboard and there is an annual return. You click on GSTR-9, select 23-24. It will show prepare online and offline. You hit that button prepare online. You will see the tiles table 4, 5, 6, some numbers. You will actually see some numbers which are auto-filled. There are numbers that actually are existing and they are visible on the screen. If you do not file your annual return within the due time, and you're considering yourself that okay, I'm less than 2 crores, the values that are there are going to be considered as your deemed annual return. I would always suggest you have to take a look at the information that is available in the portal. That is what the information would be made available to the proper officer who is going to assess. And this assessment is going to happen, let's say 2 years, 3 years, 4 years later. At that time, we don't even know if there are any differences. Even though it is optional, the second thing I would recommend that everyone file both 9 and 9C appropriately. If not 9C, but let the 9 be filed, you can make an assessment that is this the true representation of your turnover. The last thing, the due date is 31st December, which is unlikely to get extended. So make sure that you file in the due date, and this is a return which cannot be edited once filed. You need lot of caution, wherein you will correct the data whenever it needs to be corrected. But after you file it, you cannot change it. Unlike GSTR-1, GSTR-3B, you have time up until 30th November. Contextually, this is an annual return. So you are representing whatever is the turnover that you hold yourself as taxable, exempt, or ITC available, not available, whatever you are representing the values for the year is what you will be reporting here. So make sure you file it correctly, but get it checked before filing. If you file a wrong numbers, this cannot be corrected. That is something that you need to keep it in mind. Please proceed, Hitesh.
Yeah, one more point I would like to add, that if you don't file your annual return within the time limit prescribed in the law, then there is a late fees of rupees 200 per day, which is 100 rupees under the CGST Act and 100 rupees under the SGST Act. And there is a maximum capping of 0.5% of the turnover in state, which means 0.25% in CGST and 0.25% in SGST. So in order to avoid late fees and in order to be more compliant in the GST regime, we should always exercise the option of filing the annual return. Now, coming to the source of information, what all information will be required by us to file the GST annual returns? The first source of information would be, the most primary source of information would be my audited books of accounts. Whether my stat audit has taken or my tax audit has taken, such audited books of accounts becomes my primary source of information. Whichever software I'm using for extracting the data, I need to make sure that the figures as represented by that particular software is matching with my audited financials. The other primary information is readily available in the GST portal itself, like the monthly returns which we file in the form of GSTR-1 and GSTR-3B, the GSTR-2B, which has become of utmost importance now at the time of reconciling ITC, since the invocation of provision under section 16(2) subclause AA, that your ITC should match with GSTR-2B. Whatever ITC you are claiming should match with GSTR-2B, which has been inserted in the provisions of the law. So GSTR-2B also becomes a very important database for the filing of your annual returns. The additional information which we will be needing is like if any adjustments pertaining to the current year we have made in the subsequent period returns, we need to have a look over that as well. We need to cross-check with the figures reported in our previous annual returns pertaining to this particular financial year. We need to have a record of the taxes which we have discharged separately, apart from the taxes which we do discharge in the monthly returns. If any tax has been discharged separately or voluntarily by paying through DRC 03, we need to have record of that such payments as well. other two important information which we require at our end is like the details of all the notices or the demands which has been raised, notices which the taxpayer has received, or the demands which has been raised on the taxpayer at the department side. And another information is the refund claim data. If there's an SSE whose business actually pertains where he's eligible for refund, be it either export of goods without payment, be it export of services without payment, or be it refund under the inverted duty structure, where his output tax, the tax rate at which he pays his output taxes is lower than the tax rate which he is paying to procure the raw materials at his end, then inverted duty structure refund is also eligible. So in case we have made any applications for refund during the year, then such details should also be available with us for the purpose of filing annual returns.
Again, sorry to stop previous slide. Just make a specific note of the contents on the screen. Annual return is not the easy thing. It appears to be simple. That is why Ashika has made this session into two parts, which is more like a detailed working, where Hitesh will walk you through everything. These are the basic information that needs to be available with you in hand at before the start of the work. The data is available at multiple places. The data would be coming from some of these sources. We will also share you a copy of the annual return format. As we are going through, you would understand that the data is coming from different sources when we look at the instructions table. Okay. As I said in the beginning, this presentation would be shared, but make your own notes as we are going forward.
And one more thing to add, though this additional information are basically keeping in mind of the fact of GSTR-9 reporting, but this additional information will also help you in working also. It's not just for reporting purpose, but also for verification. Now, why I am saying is, as in additional information, you are noticing the fact of notice or order from department. This, though table 15 is there of GSTR-9 where I need to report about this demand and refund. But due to any notice which you have received previously, you can check impact having in current year. What I mean to say is, maybe in past audit by department or any discrepancy which department has noticed and intimated you with respect to ITC eligibility or anywhere like other income, most of the people don't pay tax. If those sort of information were given and based on those notices you have paid the tax or where you have accepted that that ITC was actually ineligible, those points you should remember while doing the GST working for the 23-24 also. So this source of information which we are stating is not just from the point of reporting or disclosure in 990, but it also works as an additional instrument to verify whether anything you have missed out while doing the working for 990. Hitesh, over to you.
Yeah. Now coming to the prerequisites for GSTR 9 and 9C. First, we need to look at the disclosures made in the audited financial statements, which particularly refer to the GST aspect of the same. So, for having a knowledge of how the figures pertaining to GST are reported under the audited financial statements, we need to know what under which heads, under what ledgers or subledgers the figures might be reported. Firstly, if in coming to input tax credit, if there is any input tax credit balance which is unutilized, I mean during the year you have made some sales you have made some purchases after adjusting all the output tax liability and with the input available with you, you still have some inputs remaining in your books, in your audited books. That particular input should match with your electronic credit ledger balance after the debit entry of the March 2024 GSTR 3B return. If that is the case, then that will be reflecting in the other current assets of the financial statements in the under the note other current assets. Now, when you pay GST under the reverse charge mechanism, what we need to do? When we are paying GST under the reverse charge mechanism, this means that we are the service recipients and we are paying GST on uh, such services received or goods received. Although reverse charge on goods is very limited and is applicable to a very few cases, 99% of the transactions pertaining to your business, if any reverse charge is applicable, it will be pertaining to services only. So in case we are liable to pay tax under the reverse charge mechanism, then what we do, we book a liability under the reverse charge mechanism and we also book a corresponding ITC of the same. That ITC is accumulating in my electronic credit ledger in the portal. Similarly, I need to accumulate such ITC in my audited books of accounts as well. So if any balance is lying there in the electronic credit ledger, which is matching with my audited financials, per se, it will include RCM ITC as well. Now, coming to two-way mismatch credits or to-be mismatch credits. If such is the case, then what we need to do, we need to reverse the ITC in our books of accounts. We need to either debit it to the respective party or to the under the respective expenditure, or if say some credit which is available in my GST portal, but the same is ineligible, then we need to directly not book such input in our books of accounts, but we need to directly expense it off in the profit and loss account. If any balance is there in my electronic cash ledger, then such balance shall be reflecting in my audited books in the other current asset head only. If any GST which has been paid on advance, now with respect to advances, GST is payable on advances only when you are in the service industry. You are providing some services and you have received some money in advance. Then only you are liable to pay GST on such receipt. If you are dealing in the trading of goods, and you receive some money in advance for selling those goods, GST is not payable on such receipt. So whenever you pay GST on advances in the service industry, then that is also something which you have paid in advance. So automatically it should reflect in the other current asset note of your financial statements. Now, with regard to output, suppose during the year in the month of March, what happened? Your output tax liability is more than whatever input you availed during the month and you had previously in your electronic credit ledger. In such case, definitely you need to pay some taxes out of your own pocket for discharging the liability for the month of March. In such case, the figure reported in the audited financial statement should be in the form of payables, which will come under the note other current liabilities of the financial statements. Now, coming to refunds. Now, we all know whenever we apply for a refund is basically pertaining, it can be either of two types. It can be, a refund of ITC on account of you being engaged in export of goods without payment, or you being engaged in export of services without payment. The second type of refund can be refund in the electronic cash ledger balance. So if you have applied for such refund, then what you need to check is the day you apply for electronic cash ledger refund, means the day your bank account gets credited from such amount, That day only, you need to reverse your electronic cash ledger balance in your books of accounts and debit the bank account correspondingly. When it comes to refund of ITC, whereby your electronic credit ledger gets debited the moment you apply for refund. Now, what you do in your books of accounts? Suppose you have 20 lakh balance under the IGST head, 10 lakh each under the CGST head and SGST head in the electronic credit ledger on the GST portal. You have applied for refund of 15, 10 and 10 under each head. You have applied for refund to the extent of 15 lakh, 10 lakh and 10 lakh under the head IGST, CGST and SGST respectively. So what you do, the day you apply for refund, you should check that your electronic credit ledger balance is getting debited in the portal. The same is getting debited in your books as well, and a corresponding refundable balance is being debited in your books of accounts. IGST refundable to IGST credit ledger. This should be the entry which can be passed in the books of accounts. In many cases, you will find that your refund application has been done in this particular financial year, but the sanction or the disbursement takes place in the subsequent financial year. So what demands our utmost attention is that in case refund has been applied, whether the same has been treated in our books of accounts correctly or not. If it is not, then we need to get it rectified in the books of accounts. For any notices, show cause notices, scrutiny notices or demand orders, what disclosures has been given in the financial statements by the company, or has the auditor put any specific remarks on the various types of notices and demands which the entity has received during the year? We can check it from the notes of accounts or from the provisions in the liability side of the financial statements, if any, which has been created.
So basically, what Hitesh is trying to say is, before we jump into the working, before we start doing matching of outward ITC, eligibility checking and all, it's very important to understand about the SSC and how the books of accounts are maintained, how the things are reported in audited financial statement. Because this all serve a very important role to determine about the GST applicability. Now, a person who is engaged in passenger transport service, if we don't know, we may straightforward disallow the ITC of the vehicle related. But in this case, it is for the further supply, so ITC will be allowed. So understanding, knowing about the SSC and also how they are recording in their books. Like in previous one, he showed multiple ledgers some people maintain. Sometimes some SSC maintain a single ledger and where they do all the adjustment. So understanding of client, their business, and how they are maintaining books of account, recording their transaction, and how the same has been reported in financial statement plays a very major role while doing the working for 99C. Like whether the books are maintained on mercantile basis or cash basis. As of now, everybody is maintaining on mercantile, but if there are small proprietors, they might be maintaining on a cash types. Like in notes to accounts, he is discussing about the disclosure about notices and demand, which also help you to analyze for the current situation. Then there are various other disclosure we made in notes to account, which relate to fixed assets, so where we can see whether any sales of assets has happened or not, any additional deduction of assets, because they also play a role which most of the time while doing 99C has been missed out. Then we have related party transaction, which are the transaction where they, even though they are recorded on the books, but GST has not been paid. So that's why he is highlighting all these points to basically make you sure that before you jump, first understand and then go ahead with it. Hitesh.
Now, coming to other reporting aspects with regard to turnover, we need to check the exclusive method of accounting. As ma'am said earlier, people maintain both mercantile and cash method of accounting. So if mercantile method of accounting is maintained, then it is not a barrier to us in our GST reconciliations pertaining to the turnover side. But in case cash method of accounting is maintained, then the turnover as per the audited financials and the turnover as per GST will not match. Second, no grossing up and reporting like excise duty. We need to check whether the sales which has been recorded, whether they have been recorded including GST or they have been not grossed up. From notes to accounts, we can get revenue recognition policy, and we can also we also need to check the time of supply as per the GST. Contingent liabilities, if any pending disputes which has not been acknowledged as debt, that disclosures are being given in the contingent liability notes, we need to take care of that as well. Coming to the notes to account, we need to check the method of recognition, revenue recognition, whether it is cash or mercantile, whether the related party disclosures have been done properly, foreign expenses and income disclosure, departmental correspondence, review of the pending cases, status of refund applications filed. If any refund which has been filed but the sanction or the disbursement is pending, then a separate disclosure must be given in the audited financial statements. We need to cross check that whether the same has been given or not. Coming to finalization of the turnover and output liability thereon. From the books of accounts perspective, turnover is different. From the GST perspective, turnover is supply. Now, what is the difference between turnover and supply? Turnover from books of account perspective can be revenue recognition as per AS9 or Ind AS 1115. Revenue which is recognized as per the principles provided in the Accounting Standard 9 and Indian Accounting Standards 115. From supply perspective, recognition basis is time of supply, Section 12 and Section 13 of the GST Act, which governs the time of supply. For recognizing turnover, there is not a it is not a necessity that an invoice must be raised. More specifically, in the field of service industry, the concept of unbilled revenue still prevails. So, to recognize a turnover, it is not very necessary to raise a particular invoice. Even if an invoice is not raised pertaining to a certain figure, the same can still be recognized as a turnover, provided it has been accounted for in the books of accounts as unbilled revenue. But when it comes to the GST, invoice is a substantial ingredient which needs to be raised as per the provisions of Section 31. Coming to the credit notes and debit notes. For credit notes and debit notes, when it comes to revenue recognition, there is no such time limit. You can issue as and when desired. But in GST, although there is no specific time limit for debit notes, but for credit notes pertaining to a particular financial year, there is a specific time limit which you need to issue up to the 30th November of the financial year immediately succeeding to which such invoice pertains.
So over here, the thing is, we want to highlight the fact that what may be the turnover as per audited financial, but may not be a supply under GST. The way the mechanism, the incomes are recorded in books, it's not similar the way it need to be discharged under GST. So that's what the comparison is been brought out. When we say turnover, we are talking from the point of view of audited financial statement, the way they are recorded. And when we say supply, we are saying the point of view when it is recognized as supply under GST and when the tax is payable. Based on this, we have given you certain sample where there can be a reason that what is recorded as a turnover may not be a supply and what may be a supply may not be recorded as a turnover. So these are the few simple example which we have taken. If you will notice GSTR-9C, even government recognize the fact that audited financial turnover will not be equivalent to what is supplied under GST. And that's the reason GSTR-9C, though start with the turnover of audited financial statement, but then it provide you 14 type of adjustment, out of which 13 is specific and one is residual. So this 14 types of adjustment has been provided, and after adjusting is what we drive as GST turnover. It's to be noted what we drive is GST turnover, not taxable turnover. This is what we drive. So while driving GST turnover, we have been given this option to adjust because, like Hitesh said out, that when we recognizing in books, we follow accounting standard or Ind AS. But when it comes to GST, it is a time of supply which determine when tax is to be payable. There can be a difference like one of the example is unbilled revenue. Then if we come to the fact of advances, like he said, advance for services is liable to be paid whenever you receive. But for audited turnover, it is neither an income until and unless I raised an invoice against that and recorded as a revenue. But for GST, it has become a supply. Revenue need to be not revenue need to be recognized, but on that advances you are liable to pay tax. Similarly, like unbilled revenue, though in which is vice versa, opposite of advances, where though in your financial you are recording unbilled revenue, but same is not offered as a tax under GST because time of supply for the same has not arisen because it's just a provision which you are booking on a matching concept for which billing will be done based on the terms of agreement entered. Then your credit notes. Now, credit notes, there is a specific lines and time limit and reporting pattern has been provided under GST. If you comply with that, then only you can claim the benefit. Otherwise, you are not allowed. Though, if we compare with audited financial statement, irrespective of the fact, what is the time limit, for which purpose you have raised credit note, it doesn't matter. You are eligible to reduce your income. But when it comes to GST, they have given only 3 specific circumstances when you can raise credit note. That is, it should be in case where taxable value or rate of tax you have overcharged, where there is a deficiency of provision of service or goods return. In those circumstances only, you can do credit note. First. Second, reporting should be made in GSTR-1 and GSTR-3B. If reporting is not done before 30th November, you are not eligible to claim the benefits. So what before direct jumping into is what we are giving you a base, a background to just to make sure that you understand there will be a difference. There will be very rare chances where audited turnover will exactly match with my GST turnover. But there will be a multiple reason for the differences. Another classic example is deemed supply. Now, if I'm not realizing any money, in my financial, I don't recognize it as an income. But Schedule 1 of GST specifically provide for the transaction even when there is no consideration, it is considered as supply. Plus, even under same pen, but as you know, state-wise registration, GSTN-wise registration, from one GSTN to another GSTN is also considered as a supply. But as audited financial statement is prepared on a pen level, it will be nullified because one sale will become another purchase, getting it knock off. But when it comes to GST, though it is not part of audited financial, you have to add it separately to drive your actual GST turnover for the period. So that is what we are trying to bring in before we jump into the working, that we should first understand that there will be a difference. There will be a multiple reason for difference, how those difference should be addressed, what would be the difference which is actually recognized by the government, where they have given in your table 5 of GSTR-9C. And there are certain difference which they themselves know may arise. That's why they have given a residual one. So that need to be kept in mind while doing the working on GSTR 9 9C. Fine, Hitesh.
Now, coming to revenue classification. Revenue classification in terms of the financials is governed by AS 17, which talks about segment reporting. But when it comes to GST, revenue classification is based on GSTR-9 reporting, whether the supply which you have made, whether it is a B2B supply. If it is made to a registered person within India, it will be a B2B supply. If it is made to an unregistered person, B2C. If it is, you have done exports, you need to report it in under the exports column. If you have made supply to SEZ units, then you have to report it under the SEZ column. Now, coming to the next point, like agreed to be made, not revenue. If you receive any advance, like we earlier quoted, if you receive any advance, it is obviously you received some money because you agreed to provide some services. So it is not necessarily that you did not agree to provide any service and you receive some money. Receipt of money is correspondingly linked to agreeing of providing goods or services, whatever the case may be. In case it is agreement of providing some service and you receive money in advance, although it is not an income as per your audited financial statements, but for the purpose of GST, when we calculate the GST turnover, we need to but for the purpose of GST, when we calculate the GST turnover, we need to take it as an include it in the turnover as per GST. These are the list of the transactions which can be adjusted when we start our reconciliation of GST means turnover as per audited financials. We can add and less, put the figures in the appropriate columns wherever they make themselves fit, and we can actually arrive at our GST turnover. Now, some examples of some incomes which can be recorded in the credit side of the profit and loss. If it is an individual, salary income will be there, but it will not be a part of my GST turnover. Other example is like discount received, foreign exchange gain, profit on sale of assets, recovery of bad debts, any penalty, damages, forfeiture. If we have recorded it in the credit side of the financial statements in the profit and loss account, these incomes do part of my audited turnover, but they do not form part of my GST turnover. We need to place it in the appropriate columns in table 5 of GSTR 9C to arrive at the GST turnover. Now, supply can be anywhere. Credit of PL, other income. In many cases, we do find that along with delivery of goods, you are raising an invoice when you sell some goods to your customer. But along with such sale invoice, suppose you are charging delivery charges, which you have credited to your profit and loss account, but you have not discharged any GST on that, even though it is applicable, because any ancillary collections which you are making with respect to a supply on which GST has not been charged, you need to pay GST on such charges as well. So whenever you collect any delivery charges or any transportation expense or anything, any ancillary charges, you need to pay GST on such charges as well. So we need to be very careful that whether GST has been discharged properly on such ancillary charges collected. Another classic scenario is debit side of PL set off against expenses. Now, loading, unloading, you may incur expenses as well, and you may also charge when you deliver such goods to your customers. So, if the taxpayer is maintaining a single ledger of loading and unloading expenses, or say transportation expenses, or say carriage inward, whatever be the nomenclature of the ledger, if he is maintaining a separate single ledger for both recognizing both expense and income, and in the financials it has been netted off, suppose your loading and unloading expenditure comes out to be 2 lakh and the collections which you have made from your customers comes out to be 80,000, which means your financial state and net expenditure of 1,20,000. But at the time of filing 9 and 9C, we need to make sure that if such loading and unloading expenses which has been recovered from the customer, if that has GST has not been discharged on such expenses, we need to take it as a part of GST turnover and we need to get that GST discharged before filing GSTR-9 and 9C. Now, when we come to the asset side of the balance sheet, we need to scrutinize whether any fixed asset sale has taken place or not. If any fixed asset sale has taken place, then there's an obvious chance that there might be profit or loss recognized in the financial statements on such sale. If any profit is recognized in the financial statements pertaining to sale of such fixed assets, we need to adjust it the same while computing the GST turnover. Going one step further, if there is a sale of normal asset, be it any air conditioner or be it any table chair or any asset which is recorded in our books of account, let's take an example of sale of air conditioner only. Then whatever is the sale value of such air conditioner, we need to pay GST on such sale value itself at the applicable rate. Now, if such asset which has been sold is a motor vehicle, then there comes a specific provision on which GST liability needs to be discharged. We need to refer back to notification number 8/2018, whereby it was specifically mentioned that GST on the sale of motor vehicles will be discharged only on the profit component. Now, how do we compute that profit component? We need to compute that profit component. The profit which we have recognized in the books is not actually the profit on which we need to pay the GST, because in books we recognize the profit as per the Companies Act in case it is a private limited company or a limited company. But in case if it is but in income tax we recognize the profit as per the income tax laws. So when we compute the GST payable on the profit of motor vehicles, we need to compute the profit on sale value minus WDV as per the income tax. What was the WDV under the Income Tax Act pertaining to that particular asset? Whatever profit we get from there, on that we need to pay the GST at the applicable rates. Two rates have been prescribed, 18% and 12%, depending upon the engine capacity. If the engine capacity is more than 1200 cc, then the rate applicable is 18%. If the engine capacity is less than 1200 cc, then the rate applicable on sale of such motor vehicle of the profit on the profit component is 12%. Coming to liability side of balance sheet, once again the advances which we have covered earlier, taxes needs to be paid on advances received in case of service industry. Outside financial statements, stock transfer and Schedule 1 supply needs to be considered as a GST, as a part of GST turnover. If I'm sending my stock from Karnataka branch to the Tamil Nadu branch or Karnataka branch to Maharashtra branch, although it is an internal transfer, I won't be recognizing such stock transfer as revenue in my books of accounts, but for the purpose of GST, it will be deemed to be a turnover. Now, coming to the reconciliation part. Reconciliation should be multidimensional so that it gives us a clear picture of what type of supply has been reported, how much at which rate it has been reported, whether the rate which has been charged, it is charged properly, whether the taxes which have been paid have been discharged properly. So in order to perform the reconciliation, we need to reconcile all three, books versus GSTR-1 versus GSTR-3B. We need to reconcile turnover both interstate and intrastate. classifying this will actually give me the tax type which needs to be charged on the appropriate supply. Coming to report segregation, we need to segregate it rate-wise as well, depending upon the nature of business of the entity. Supply-wise, rate-wise, supply-wise. Supply-wise means taxable, zero-rated, with payment, without payment, exempted, nil-rated, and non-GST supply. Registration-wise also, we need to make the reconciliations in case it is a multi-GSTI entity. Now, when the case is of a multi-GSTI entity, the books turnover will be consolidated. I mean, if an entity has 4 branches, then the audited financials will have a consolidated turnover of all the 4 GSTIs. What we need to check is all the 4 GSTIs added together plus my stock transfer gives me the total GST turnover of the entire entity. Stock transfer will be added with the respective GSTI turnover as well, and when we compute GST turnover of all 4 entities together, it will be added again. Computation of taxes thereon. Now, whatever the turnover which we have reported in the returns, we need to match it with the tax rates which we have discharged. The taxable supplies. Taxable supplies can be deemed B2B, B2C and deemed export and zero rated with payment, which means you are exporting the goods with payment of taxes. Non-taxable supplies will be zero rated without payment. That means you must have exercised an LUT for exercising this option and exempted turnover. Goods which are exempted from GST by way of a notification. No supply means transaction in money, and if you are owning a petrol pump, so supply of diesel and petrol, or if you are owning a wine shop, means supply of alcoholic liquor for human consumption will come under no supply. Rate wise, category wise, we need to see whether it is a good or service, and we need to classify it under the correct HSN and apply the correct rate of tax which needs to be applied as per the rates prescribed in the HSN. This can be used as a sample working note for the liability computation. Outward supply on which tax is payable, we can classify it as rate wise and as per books, and we can specifically make as per the returns filed as well. Another one which we can classify as zero rated, exempted, nil rated, non-GST, whatever the figures we need to put in the appropriate columns, we can put it there, and then we can move ahead with our reconciliation processes. What our ultimate goal should be that the total turnover which we are computing for the purpose of GSTR-9 and 9C should be accurate. When it comes to reconciliation with, yeah.
Okay. Now, the thing is that we are now working on freezing of our GST turnover. Now, we explain you that there can be a multiple scenario, multiple reason for difference between audited financial and GST turnover. So the first thing which is needed to be done for starting with this outward working is to freeze my GST turnover. So if you are a multi GST SSC or even a single GST SSC, first thing you have to do is to drive your GST turnover. If you are a multi GSTN, then you have to drive your GST turnover per GSTN. Each and every GSTN need to be driven separately. So let us start Suppose my audited financial statement is 100 rupees. I am having 4 GST registration, out of which suppose 2 GSTians I am having 30/30 and balance 2 I am having 20/20. Now this audited financial statement figure will divide into GSTN wise turnover. After that, we will do the adjustment as shown in GSTR-9C, and there can be residual adjustment which will be covered in 5O, and GSTN wise we will get the GST turnover. After getting that GST turnover, GSTN wise, we will further subdivide into exempt, taxable, zero rated. So we will further subdivide into what is my taxable, what is my exempted, what is my zero rated. After dividing this, it need to be also further subdivided. Now, if we see zero rated, it consists of two parts. One is export and one is SEZ. Both need to be divided. Reason are there are different compliances. When we see export of goods, it simply says goods should move out of India. So my shipping bill and bill of entry do the said work. That document take care of it. When I say export of service, then though there are 5, but 4 are the important condition. 5th one is related to when transaction is happening between one entity, means outside party is a branch of it, then it will not be considered as export of service. But otherwise, what are the other condition which has been prescribed is that I should be in India, well, the person providing should be in India, person receiving should be outside India, then I should receive in Forex, and my place of supply should be outside India. All those compliances need to be taken care to make sure that while reporting, you are actually complying with export of service definition. We have seen multiple ASMT 10 has been issued where they are saying about the fact, give me export related document. They want to verify whether you have fulfilled the export conditions or not. LUT has been executed or not. Even though it's a 8-year-old GST, but still people are missing out to file LUT, or they have done delay in filing LUT. I'm not going into a dispute that it's a procedural, non-procedural, what will happen of non-reporting. But I'm just letting you know that why we need to do this classification, and why in 99C separate row tables have been provided to give those details, because it works as a base for department to check what you have disclosed, have you disclosed in compliance or not, so that they can ask you documents for that. So you need to be careful with that. Then when we comes to exempt, if you will notice, he specifically said exemption should be through notification. So there is a specific exemption notification for goods. There is a specific notification for service, which is exempt in the service. So before we classify any goods and service as exempted, we have to make sure you have read that notification, you know the entry number based on which you are claiming that exemption. If it is not coming an exemption, how you are classifying it to be an exempted supply is itself is a question mark. For service, it is notification 13 to be read. Sorry, notification 12 to be read for exemption. And for goods, notification 2 to be read. These are all principal notification which have kept on amending. When I said this notification, I'm saying as on date amended. So you need to have to look into it, what you are classifying, and the basis for such classification should be supported by document or a law. There should be a reference based on which you are classifying it to be. Now coming to a non-GST supply, non-GST supply is basically a Schedule 3 item. Now people have a habit of putting everything under non-GST to make it match with taxable supply. That should be avoided. You should see what is a non-GST. Each and everything, like he showed you few example of in a proprietor table where there was a discount received, foreign exchange gain. If you will notice 9C, there are separate tables are given, rows are given to report for those. So you should do specific reporting on those instead of putting everything under non-GST. and creating problem for yourself because you have to only give answer to the officer. If respective tables are properly reported, you are reducing your chance. See, as we sir also pointed out at the beginning, that all this which we are doing today will be questioned after 3 years or 5 years. Department has a time of 3 and 5. At that time, will be able to remember all this thing. So it's better while doing working, all this thing is taken care. And base is also written. If you are saying something to be exempted, you should specifically write beside it, based on this entry number of this notification, you are considering it to be an exempt. Or why you are classifying as non-GST, these are the component which I am classifying non-GST. So you should divide your audited financial after driving the GST turnover. You should divide your each and every ledger and specifically classify those ledger by, see, Excel is a tool where you can do the formula and you can write each and everything over there, that this ledger I'm considering as taxable, this ledger I'm considering as exempt, with specific reason recording, which will help you only in future. When we are talking about the reconciliation, we are just not talking the reconciliation point of the figure matching. We are also talking from the point of view that the steps or the documentation you need to make sure. Like in export, I said, in zero rated, I talk about export. But if you come to SEZ, now they have clearly stated that it should be for authorized operation and it should be endorsed by SEZ officer. You have to make sure. There are cases in past where SEZ compliances were not done, even though it was belatedly introduced. But due to that, multiple cases are lying. People are still disputing those facts. They are in litigation. But now, as on date, while doing 99C, we can take care of it. If those compliances are not there, we can inform. Because if we inform after 3 years, who may know, don't know whether they will be able to get it done or not. But today, while checking, we can make sure of it. After this classification, it's not just important that I have correctly classified my exam, zero rated, taxable. But after that, it's also important that rate which is applicable has been properly paid or not. That's why rate wise reconciliation is also important. It may be a case, it might have been wrongly disclosed in GSTR-1 rate. And as we know, 3B auto-populate based on GSTR-1 may not be corrected and wrong tax has been paid. So with the supply type wise, rate wise repo is also plays a very important role. Because while doing the reconciliation, if you find out that some rate has been wrongly reported, now can be taken care and be discharged through DRC 03. Similar is the supply type wise, if wrongly reported, can now be taken care. If classification wrongly done, value wrongly reported, all those things can be taken care over here. That's why we talk about this reconciliation to be done in such a way that it take care of each and everything, making sure if anything happened from the department side, any action is taken, you are well prepared with it. That's why we are discussing about so much of working and we have kept it as a separate part. Because if this is taken care, then filing of 99C will also become very easy. It will be more of linking instead of more of working. Because reporting automatically based on this working, reporting will be properly taken care. Hitesh.
Yeah. Coming to the reconciliations which we need to do with the income tax. For supply of goods, we can do the reconciliations with TCS under section 2061H, where supply is more than 50 lakhs to a particular party. And if the total turnover is more than 10 crores, then we can cross check with that as well. For scrap sale, if any entity is engaged in any scrap sale, we can reconcile it with TCS under section 206C. For supply of services, we can definitely refer to 26AS as generated by TDS CPC, and we can check details of the TDS. Coming to expenses with GST.
1 minute. The reconciliation, which just now Hitesh talked about, is an extra reconciliation. It's upon you whether you want to do it or not. But we have seen department has started issuing notices based on Form 26AS also. But it's all upon you because based on 26AS, demand cannot be made. That's a separate part. But these are additional. But you can do the reconciliation with e-invoice, e-way bill to check because these are the GST related documents. This comes under GST. So those recos should be done before filing your GST return 99C.
Coming to expense analysis. Now, first we need to bifurcate whether the expenses with GST and without GST. The expenses which are with GST, we need to again cross check whether such is eligible. If it is eligible, then yes, we can claim the ITC. Secondly, if it is ineligible, then we need to, the GST component of such expense should be expensed off with that respective expenditure only. Thirdly, if there are expenses without GST, that means which are exempt or under non-GST or RCM. For RCM, if the suppose transportation charges, if we consider an example of transportation charges, the transporter who is giving me the bill, he is not charging any GST. He is just giving me a bill of 5,000 rupees and I have to pay GST under the reverse charge. So it comes under expense without GST. It does not have any GST in it, but it forms part of my total expenditure as reported in the audited financials. So first and foremost, in the expense analysis, we need to check which all are the expenses of which contain GST. When we segregate such expenses, we need to further segregate that the expenses which are containing GST, whether the same are eligible or whether the same are ineligible. If they are ineligible, we should expense it off with the corresponding expenditure only. The GST component of such ineligible ITC should be expensed off with the corresponding expenditure only. Now, coming to ITC availability on the basis of use. In the earlier slide, we said that we need to bifurcate expenses into based on GST, whether GST is there in that part of expenditure or it is not there. Even if it is there, we further check whether it is eligible or ineligible. Now, suppose there is an expenditure on which GST is there, but again, one step further when I move, I need to check whether such expenditure on which GST is there and ITC is eligible as per the provisions of GST law, whether such expenditure has been fully incurred to make taxable supply or zero rated supply. If such is the case, then ITC is available in full without any doubt. But in case if such expenditure on which GST is there and it is also eligible as per law, but such expenditure has been incurred to supply any non-taxable supply, exempt supply or nil rated supply, then specifically for such type of supply if it is incurred, ITC will not be available to me. But in case some expenditure like printing stationery, like audit fees, professional fees, brokerage, rent, these expenditure which are very common in nature, which are daily admin expenditure in the course of business. If these expenditures are incurred and I am a business entity which is engaged in supply of both taxable and exempt supplies, means suppose I am a grocery store, so I am engaged in both taxable and exempt supply. So all these expenditures which are commonly attributable, I mean rent, professional fees, audit fees, or your brokerage, printing stationery, all these common expenses which I incur in my day-to-day running of the business, this shall be classified as common ITC and proportionate reversal of the same should be done at our end before filing the annual return so that later on no such demand pertaining to this issue comes to us. Why proportionate reversal should be done? Because the same has been prescribed under Rule 42 of the CGST rules.
So if I summarize what he has said is, one is, let us divide ITC into three parts. One is ITC specifically used for providing taxable supply. That is 100% eligible. Second is ITC specifically used for providing exempt supply. That is not allowed. It's an ineligible ITC. Now there can be an ITC, the concept he discussed about common credit, which he talks about rent, security, auditor fee. Those are common expenses. There can be other also. Those are common expense which cannot be divided as being specifically used for taxable or specifically used for exempt. Those common credit you would be eligible only to the extent of taxable supply. So the turnover ratio will apply, and based on those proportionate turnover ratio, you will be required to avail the ITC. Either you are required to avail to the extent of taxable supply, or if I say in other word, you have to reverse the ITC in relation to exempt supply. So this is how you have to divide your ITC, understanding whether you are eligible to claim or not. This is ITC dividation, but further we will take you where ITCs are specifically disallowed.
Now, coming to the time limit concept. The time limit to claim ITC pertaining to a financial year is 30th November of the financial year immediately succeeding the financial year to which such invoice or debit note pertains, or date of annual return, with filing annual return, whichever is earlier. So for financial year 23-24, coincidentally today is the last day to claim ITC, any ITC pertaining to financial 23-24, provided if we have not filed your annual return yet. Coming to finalization of eligible input tax credit. Now, we need to match the expenses with GSTR-2B. When we do that, we get three scenarios. First, credit matching with those appearing in the portal. We don't need to take any action. Second is credit appearing only in books and not in portal. Now, if such is the case, then whether we are eligible to claim the ITC, we need to decide, because if such ITC is not reflecting in my GSTR-2B, then as per GST law, it is not eligible. We are not eligible to claim such ITC until and unless it reflects in our GSTR-2B. Second check which we need to do, we need to check whether the same is in a relation to our business or not. Third scenario which may arise is that credit existing only in portal and not in books. When such scenario arises, we need to cross check whether the same belongs to us, because there might be cases that the ITC doesn't even belong to us, but the supplier has wrongly put our GSTN. Accordingly, it has auto-populated in our GSTR-2B. So we need to cross check those as well. And if it doesn't belong to us, we need to expense it off with in our books of accounts. Coming to the concept of block credit under 17.5. These are the specific credits which has been restricted by the GST law, and they say that you are not eligible to claim such credit if any of such credit, even if it is reflecting in your GSTR-2B, you are not eligible to claim such credit. First credit is motor vehicles, conveyance, rent a cab. Until and unless you are engaged in the same line of business, or you are engaged in the business of imparting training, you cannot claim ITC on motor vehicle having a seating capacity of less than 13 persons. For food and beverages, you are not eligible to claim any ITC. NRTP or any NRTP, he is also not eligible to claim any ITC. ITC cannot be claimed on life insurance premium paid, health insurance premium paid for companies who actually pay these incur these expenses on behalf of their employees. They are not eligible to claim such ITC on life insurance and medical insurance of the employees. If they're incurring any such expenditure, they're not eligible to claim ITC. Another important block credit comes to goods lost, stolen, destroyed by way of gift or free samples. Many a times we see that in order to promote the business, companies give these free samples to their customers as a gift, or companies may give dealers means bonus to their dealers as a gift. So in case this is the scenario, then ITC will not be available. ITC will be blocked. I mean, let's take an example that there has been some fire in my godown. So the goods which I procured and kept in my godown, that has been lost due to fire. At the time of procurement, I must have claimed ITC. But since I will not be able to sell those goods because the same has been destroyed by fire, then I need to reverse the ITC which I had already claimed. Or in case I have not yet claimed such ITC, it is lying in my 2B, then I need not claim that ITC and reverse it permanently. Secondly, if I am providing any free sample to my customers, then in such cases also I am not eligible to claim any ITC. Any beauty treatment, cosmetic and plastic surgery, ITC of the same will also be not allowed under any circumstance. Coming to this is an important rule which has been prescribed in the CGST rules, although the compliance pertaining to this rule is not very high when we compare to the compliance with the other rules given in the GST rules. But this is one of the important rules, because if we don't comply now, in future when audit comes or when any scrutiny assessment arises, the officers ask us to reverse the ITC as per this rule. What does this rule say? That if you have not paid your vendor within 180 days of the date of invoice, then you need to reverse the credit availed along with the interest. So in case you have not paid anything, you have not paid for the purchases made from your vendor within a time period of 180 days from the date of invoice, then you need to reverse the credit, and you can reclaim such credit when you actually pay the amount to the vendor. In case this is not being done, we ought to do this, because for reclaiming of ITC, there is no time limit prescribed. Time limit has been prescribed only for claiming of ITC. So in case I don't pay, if you find any scenario that your client or the taxpayer has not paid to his vendor within a period of 180 days, you can easily figure it out with the creditors aging table. Pardon. So if there is any creditor which is outstanding for more than 180 days, ITC with respect to such should be reversed, and the same can be reclaimed once the payment has been made properly to the creditor.
So basically for ITC, now it is based on GSTR-2B 23-24, unlike 22-23, where it was came in between of August 22. For 23-24, it is the GSTR-2B which is based for claiming ITC. Now, the GSTR-2B of that period, you have to check whatever Hitesh has just now discussed. You have to check how much is the block ITC involved there. The common block ITC, which we have noticed, because it may from industry to industry again differ. So common block credits are like insurance. Now you have to check anything in relation to medical or health insurance or life insurance if there has been not claimed or it has been reversed in table 4B1 of GSTR 3B, which deals with permanent reversal. Then second, in relation to food and beverages, like there will be puja sweets and all, that also need to be reversed. Those ITC also can't be claimed. Then you have sometime as vehicles are purchased for the director, they say it to be a company and they claim it. That also is disallowed. Stock insurance, he has already discussed. Then where there is a loss of goods, that also he has discussed. Free sample, he has said. Free sample is a disputable, but we are not going into it. But based on the quantum involved, you can decide whether to go for a litigation or you want to reverse and close the case over here. Then cab related charges. If renting of motor vehicle related charges are there, those are ITCs are also blocked. So these are the common expenses which I said you will find under block credit in your 2B. Based on industry, it may change, but those ITC you take care that it has been either not claimed. Using of the word not claim would not be correct because as of now everybody has to report as per 2B. So total of 4A will match with should match with 2B and all this ineligible should be reported as table 4B1. But as we are doing 99C, we are seeing still many SSCs are there who are not following this pattern. So how we can address and how the reporting will happen in 99C we'll discuss in our next session. But while doing your working based on 2B, you make sure as of now for your remark, you have marked it to be ineligible ITC. How they have dealt in 3B, how that reporting need to be dealt, we will do in our next session. But a comparison need to be prepared of what they have considered as ineligible and what is coming as per law based on your determination. That block credit working need to be done. Then is your second is a place of supply not equivalent to location of supplier. That also need to be checked. When I say place of supply not equivalent to location of supplier, I mean to say if it is a GSTN of Karnataka and CGST and LGST belongs to another state, then you can't claim ITC. Those need to be also disallowed. Similar fashion, it like if my place of supply is Karnataka, it should be Karnataka CNS. It cannot be other state. There may be a situation that wrong type of tax has been charged, that it should be I by mistake charge as CNS. Those also you need to be careful. If it is done, it need to be based on quantum. It will be decided how you should take care for future or how that adjustment need to be done. Then comes your part of two other rules, which is payment to be made within 180 days, which he has discussed. You have to check whether you have made to your vendor within 180 days. If not made, you have to reverse. Though there is an option you can reclaim once the payment is made. Now, the thing is that why people are not following this is they know what will be the consequences. The thing is that max to max department can demand interest, but they can't disallow me the ITC because may not be in the month of April I am eligible, but when I made the payment in the month of September, I became eligible for the ITC. The only thing which has happened is that I have availed the credit prematurely. So before it become eligible to me, I has availed, which would have become subsequently. So based on that, they can demand me interest. That's the reason most of the people doesn't comply with it. And this is the provision which is coming from pre-GST design. And the second part is 3B non-filer. If there are the suppliers on whom you have taken ITC and they have not filed 3B, in those cases also you are required to reverse the ITC. How you can check 3B non-filer? If you will see 2B, there is no option to check whether my supplier is 3B filer or not. But if you go to GSTR 2A, there you will file a separate column of 3B non-filer. So you should go and check that. If there is any of the 3B non-filer, you have to reverse the ITC for the same. Similar like the situation with payment with 180 days. In 3B non-filer also they have said when my supplier become compliant, means when he started filing, then you can reclaim it. So same way, the way payment within 180 days, the same type of provision has been provided for 3B non-filer. That check also need to be done. So based on 2B, you have to determine your eligibility. Eligibility is not just block credit 17.5, but also section 16.2, which says about the that you should be in possession of invoice, goods or service should be received, payment to the vendor should have made, you should have filed your return and it should be disclosed. All those compliances also need to be taken care. So 16 and section 17 both need to be checked while determining your eligibility of ITC, which will be purely based on GSTR 2B. Because if even though my books is more than 2B, I can't claim. Now that 2B is my base, and based on that, only my ITC for the purpose of the 9 and 9C will be determined. Hitesh, over to you.
Coming to the reverse charge mechanism. While doing the workings for GSTR-9 and 9C, we need to check the RCM impact, whether the RCM liability has been correctly discharged in my monthly returns or not. If not, then we need to correct it at the time of filing annual return. And in this slide, we have tried to give you some specific examples of the expenses on which RCM is applicable. The tiles which are colored in blue are the most common expenses on which RCM applicability comes into the picture during the normal course of business. The first and foremost is transportation services availed from a GTA. Now, if GTA nowadays has the option to exercise forward charge or reverse charge. So it becomes of prime importance. We need to first check whether GTA has opted for reverse charge or whether he has opted for forward charge. If he has opted for reverse charge, then he must be giving a disclosure of the fact in the invoice which has been raised by him, so that we discharge of the tax liability in a proper way under the reverse charge mechanism. The second major expense to which RCM is applicable is the legal service, fees to lawyers. If we are paying any fees to lawyer or advocates for any of the services provided by them, then we need to pay reverse charge under those services. The third comes the sponsorship service. Another important service is services by central government, state government, local authority, or the union territory. The services which we receive from the government, on such services also we are liable to pay reverse charge, but in most of the cases it is seen that the same has not been taken care of. For director service, the easy way to sort out is that if the director is an executive director, you must be deducting TDS under 192 of Income Tax Act. In such cases, RCM will not be applicable. But in case your company is having an independent director who is only charging you board meeting sitting fees, and you pay him board meeting sitting fees after deducting TDS under section 194J, then in such cases you need to pay RCM on such director board meeting fees as well. Still, after the 7 years of implementation of GST, this director service, reverse charge on this director service is being missed by many of the filers. Security services, if it is provided from a non-corporate to a corporate entity to a body corporate who is registered, then you need to pay RCM on such security services availed. Renting of motor vehicle, again, RCM is applicable. One additional caution in this has to be that even though you are paying taxes under RCM, until and unless you are in the same line of business, you cannot avail ITC of the same. So even if the company incurs cost of renting a cab for its employees, it has to pay taxes under the reverse charge mechanism, but ITC of the same will not be available. And the last one, which is highlighted, is renting of immovable properties. With regard to renting of immovable properties for the financial year 23-24, we need to take care that wherever any residential dwelling which has been rented out, but it is being used for commercial purpose, such residential dwelling will come, such rent expenditure will come under the purview of RCM. Very recently, in the last month itself, another another notification pertaining to renting of immovable properties has been brought under the scope of RCM, which says that renting of commercial property by an unregistered person to a registered person will also come under the scope of RCM. But keeping our discussion limited to the filing of annual return for financial year 23-24, with regard to renting of immovable properties, we just need to check that whether we are incurring any rental expenditure on a residential dwelling which is being used for commercial purpose. If that is the case, RCM needs to be discharged on such rental expenses incurred during the year. These are the RCM applicable on the supply of goods: cashew nuts, silk yarn, lottery, used vehicles, PSLC, where you need to pay RCM for supply of such goods.
So basically for RCM, now the thing is that based on GSTR 2B, whatever is showing as RCM, yes, people are discharging that. But they fail to acknowledge the fact not only the case which is showing under GSTR 2B, but there can be also other expenses. Because wherever the suppliers are engaged in the supply of the notified services or notified goods which are covered under RCM, they may not be registered under GST. Because what auto-populate in GSTR 2B is based on registration. So who are registered, their data is getting auto-populated and you are making compliance. But the person who are not registered, even though they may be covered under RCM. That's why what we do is we refer to trial balance. We go to the expenses. We check which are the expenses based on the name, like legal and professional for time being, if we say. Based on this name, I will go and further verify whether any advocated related expense has been booked in this or not. Because advocate may not be registered, but it is liable to under RCM. So in TB expense wise, you have to do the checking. You have to identify anything which can be covered under RCM so that you don't miss to pay the tax liability. Now, this is important not only from the point of view that you have to pay the tax, you have to pay the interest, but RCM also come with one benefit of availment of ITC. Subject to the condition, it is not block ITC. Like one of the example was discussed about renting of motor vehicle. Though it is under RCM, but ITC is not allowed irrespective of the fact it has been used for business. But there are other expenses on which taxes paid under RCM is eligible, like sponsorship service, legal service, renting service, government related service. Now in this slide, the services of goods which we have covered are the one which are applicable for 23-24. It include only 23-24. It does not include the one which recently got introduced. I hope you all will be aware about the commercial property bin coming under RCM, renting, if it is from unregistered. We are not talking about those. We are only talking about the facts which is applicable for 23-24. So when we said about renting of immovable property, at that time, it was in relation to residential property, where the residential property has been let by unregistered person to a registered person, then only it is under RCM. Commercial property has been introduced now from October. So don't consider that for discharging the liability. So this is all with respect to the workings which you need to do for outward, ITC and RCM. So basically we divided our discussion on this three and what are the checkings need to be done on these three items. Now, there are multiple places where people miss, which has also been highlighted and which I am once again highlighting for the sake of that you keep in mind and don't forget. And while doing 99C, you take care of it. Now, newly introduced is a corporate guarantee. So you have to check. One is director personal guarantee, which by way of clarification, government has also said no tax. But corporate guarantee, they are saying tax is leviable. I'm not going into a dispute whether tax payable or not payable. I'm not going into it, but I am just bringing into your point, your consideration that these are the clarification which has been issued, which you need to be take care while filing your 99C. So if any of the corporate guarantee is there, check whether taxability will come or not. Related party transactions are the places where people miss to pay the tax. Rule 28, which says whether when you are eligible for 100% ITC, then even a zero value will be considered as a right value. But you keep this in mind that if related party transactions are there, check whether Rule 28 compliances are made or not. Then corporate guarantee, I told you. RCM introduction, RCM part is renting of immovable property, residential immovable property from unregistered to registered. You need to check, which may be a miss. Okay. Then government related services. Over there, you need to be careful. It has been noticed in multiple cases where it has been deemed to be a statutory requirement. You have to differentiate whether it's a statutory requirement or other than statutory requirement. Based on that, RCM liability will be determined. Then royalty, for which recently Supreme Court decision has also come. I'm not going into it because if anybody is paying any royalty, check if you're paying to government whether RCM has been paid on the same or not. Import of service, transaction between foreign related expenses are also a place where people miss to pay tax. And you should not miss to pay tax because you are eligible for ITC. So import related, you should check thoroughly. If anything is there, pay the taxes, claim the ITC. Now, but you may ask me that we are over with 30th November, 1-3 we all filed. While doing the RICO, we may identify that there are cases where RCM liabilities are there, but not paid. What you should do? In my opinion, you should pay it through GSTR-3B in December while filing your November month instead of doing it through 9 and 9C. Why? Because it will become difficult to explain to the officer tax payment made through DRC 03 of 99C and ITC claim in GSTR-3B. Because my table 3.1D, which showed the amount I am paying, and table 4A3, which show the ITC I claim. My ITC claim will become more than tax paid, and there you will get the notice. So it's better you pay through GSTR-3B. Now, the second question you can ask me that what about time limit? If we see for 23-24, 30th November is the last date. So those time limit has become over. But over here in RCM, they have issued a specific clarification that if you are paying belatedly, you are raising the self-invoice belatedly, you will be liable to pay interest and penalty for delay raising of invoice. But ITC to avail will be based on the self-invoice issue. Time limit will be running based on self-invoice issue. So those are the pointers from my side that you should take care in the working of GSTR-9 and 9C. So you want to add something? We'll take the question.
Before we move on to the tech session, a couple of points. Firstly, thanks Hitesh and Ashika for taking us through the detailed workings that are required for generating the GSTR 996. Participants, the session we only touched upon. We haven't got into the details of 9 and 9C. Format has been shared with you. Anyhow, one more copy will be sent over email. Please have it handy in the next session which we are going through. Get your table numbers ready, and in the next session we will be looking at cross-linking of data from one table to another. Right now we only said what is the data that has to go to the annual return and what is the workings that are required for your turnover and the ITC. You might have a lot of questions that, okay, table 8A has changed from 2A to 2B, what do I do? I have reclaimed and not reversed the credit, or it is still parking to be reversed. You might have a question. Someone was asking that, okay, I have availed ineligible credit. Now, what do I do in the annual returns? You will get all lots of doubts. In the next session is we will jump into between 9 and 9C, cross-linking of the tables and the data. But before we sum up and wind up for this session, Hitesh has walked us through after you prepare the turnover from PAN-based turnover to the GST-based, prepared lot of reconciliations, saying that the same turnover, which you have seen the outer number, you prepare it by rate wise, by HSN wise, interstate, intrastate, between B2B, B2C. So all category of the turnover workings have been done. And at the end, Ashika also explained about reverse charge. I want to highlight two things when it comes to both output and input. In GSTR-9, Table 4 and 5, Part 2 talks about liability. In Table 4, you report the transactions where there is a tax liability is there. In Table 5, you will report where there are transactions, no tax liability is there. What you should be worried in the annual return is all the data that you are reporting as exempted, nil, non-GST, or exports SEZ. Why you have to be worried? Because you have not paid the taxes. Your documentation should be more. If you say that you have exports under LUT, do you really have an LUT? If it is services, have you ensured section 12 of the IGST and 13 of the IGST for the place of supply has been properly identified? Most times you will see notices for interstate supplies as C plus S, for exports as saying that it is a domestic. So you need to have a documentation where there is no taxes being paid. Likewise, it's quite common that every accountant, when it comes to the input tax credit, month over month will be doing a reconciliation between GSTR-2B and the books of accounts. There would be an email going to the vendor, something is not appearing, or between the accounts checking why the invoice is not there in the books, which is there in 2B. That reconciliation is quite common that happens. But while you are filing annual returns, you should necessarily do an exercise of the total expenditure in the P&L vis-a-vis the expenditure that is there in the 2B. Your 2B is a subset, excluding the capital goods. 2B is a subset of the P&L. Only an assured where you don't have GST liability is the depreciation, amortization, or the salaries that are paid. Every expenditure where you are not having an input tax credit, you need to have a reason. Like why you have not paid output tax, which is reported in table 5, you need to have a reason. You also need to have a reason why these expenditures are not appearing in 2B. Either they are purchased from a composition dealer, purchased from a registered dealer, but these are exempted purchases, or is it under RCM is something that you have to establish and those workings are mandatory. RCM values are changing time to time. Every year there is a list that goes up. two important things. Firstly, you need to know what are the changes happened during the year. Like Ashika was mentioning, on the residential dwelling, there is an RCM that has come. Residential dwelling given to a registered person, RCM has to be paid. And department would say that it has to be paid from that period also. So you need to know what is applicable for RCM in 23-24 and what is not applicable for RCM in 23-24. That also you need to have a proper clarity. Because 16 subsection 4, the time limit to avail credit is applicable for forward charge credits and also reverse charge credits. Finance Act 2024 has amended specifically the provisions of RCM, stating that raising invoice is now a mandatory scenario, the self-tax invoice. So you cannot eternally keep carrying forward the year in which I am paying RCM, I'll be taking credit. You got one-time benefit and amnesty saying whatever is the past, we are taking care. Don't expect that these things we will have eternally. So preparing the workings for the annual returns are more important. And in the next session, it would be little fast. It would be more on understanding the tables, understanding where the data is going from one table to another table, between 9 and 9C, cross-linking, cross-reference. And the quite common questions that are pondering in the current year is the reclaimed credit is also coming, like electronic credit reversal and reclaim statement is coming twice as a credit in 4FI. How do I reconcile? How do I present it? The carry forward credit, all those discussions would be coming in the upcoming session. Ashika, is there any questions that are not answered that needs to be taken?
Just 1 minute, we'll look. If anybody have any query, they can unmute and ask also.
Yeah. You can actually unmute yourself and ask a question. Ashika, you're on mute.
In case of director fee, RCM is applicable for cooperative bank or max societies.
Okay, the word director is important. Now, the moment we say a director, most of the societies, cooperative societies everywhere, the elected body, nominated body is also be called as directors. Just because the word director is there, it really doesn't mean the RCM is applicable. You have to look at the entry in 13/2017. The word director is associated with the Companies Act. So anyone who is qualified as a director under the Companies Act, this provision is applicable only to them, and not just because someone has been named as director. In large corporate MNCs, you will find someone as associate director. Might be an employee, but the designation given as associate director. So the word director doesn't necessarily be the designation internally given. It has to be the director as per the Companies Act.
Then one question is, in case of plastic surgery, whether are liable for GST registration since ITC is not available?
Okay, you are now, whomsoever asked the query, you have asked two independent queries, but actually the query is not clear. But let me try understanding if this is what your query is. Given that the ITC is not available for the plastic surgery, do I need to take a registration? Now, both are independent. First, you have to get the services provided by a healthcare professional are exempt. What is not exempt is those exceptional services, which is beauty treatments. Now, your service as anything falling as a beauty treatment is taxable. Because it is taxable, you have to take registration. It doesn't mean whether the other person, the recipient, will he get ITC or not is independent. The exception to beauty treatment is both dental, face replacement or plastic surgery, it is necessary to be done as an operation in case of any decongeniality from the birth or over the accident, something has happened. Those are still exempt. They are all healthcare professionals. But we know VLCC, all weight reduction, weight gaining, skin tightening, other services that happen. These services are also performed by doctors, but these are not exempted from GST. Hence, the person who is providing those services should need to take a registration if the annual fees earned is exceeding 20 lakhs.
So this is last one. Though it is answer, if client has availed ITC in 3B, but in books the same is expensed off. The books are finalized, audit is completed. Do we need to reverse credit in GSTR-9?
Okay. What's your view?
Okay, so if we say legally, that is what the answer Hitesh has given, that you are required to reverse based on matching of books with my ITC in means legally, because I have expense off, so I can't claim. Now the thing is that reporting done in 3B is summary level. Nobody knows what ITC I have claimed. Even when the books is what the data you are going to give to the officer, he will not come to know until you disclose that this ITC has been expensed off. When the officer comes, anyhow, people are now have become smart. They themselves give GSTR to be printout. This is my ITC detail. Now they no more give books ITC. They give 2B only printout. Just check total should be more than my 3B or it should be equivalent. So if I say you from department point of view, they will not come to know until and unless you disclose. Now coming to matching of discrepancy between books and 3B, what you can do is, as you have expensed off in 23-24, now you can reverse that expense off if you want to match, and you can still keep it in my 3B as ITC claim. Even if you don't do that adjustment, nobody is coming to know until you yourself disclose it. So that is my answer.
Okay, so again in GST, unless otherwise you have anything given in the act, anything you hear from anyone, I want every one of you to get, it is a view of that person. It is not the law. Under GST, we have cases in Supreme Court and some matters which were held by High Court as yes, Supreme Court said no, and vice versa. So anything written in the act, only the interpretation of that can go to the thing. Now, beyond that, if we are talking, it is likely that what you are hearing is not the answer. My answer to this statement, books of accounts are independent of GST. Whether I expense it in the books or I treat it as current asset, it is my way of maintaining books of accounts. GST law doesn't go with the books of accounts. Had that been the case, I don't report 3B any ITC, or I forgot to report the ITC. I can still go ahead and claim that I have a credit in my books. Why don't you treat that 16.4 is fulfilled because I have reported the credit? In Bharti Airtel case, the Supreme Court categorically has said, your books of accounts, if it is not finalized, you are waiting for GSTR 2 and 3. Now you are coming and saying that the 3B was not a return, and you are waiting for the 2 to be corrected and populated, and hence you have not taken a credit, is not a right statement made by the Bharti Airtel. What is given in the Act? If you look at 16 subsection 2, the conditions to claim the input tax credit, if that has been fulfilled, you are eligible to take the credit. Only the specific where you will not be eligible to take the credit if ITC has been capitalized, 16 subsection 3 has been capitalized and you are claiming the depreciation income tax benefit, that you are not eligible. So plain, I debit purchases with the GST to the P&L, but in my input tax credit ledger, I am availing. I don't see any issue. I absolutely don't see any issue. My purchase register, I still made the purchase of the goods. There is nothing wrong. Whether the debit is there as a revenue item, capital item. Today we are all in double account, double entry system. So the liability of the taxes collected, it is there in my current liabilities payable. And if that has been paid through ITC, which is there as debit, eventually at one point that should be offered back as an income in some or the other form. So my view, the booking ITC as an expenditure has got nothing to do with the claim, because 16 subsection 2 is what the department should be worried. Hypothetically, if they are saying that this is an ineligible credit, I am disallowing it. You have taken in the 3B, but I am disallowing it. Now they should be making a demand, show cause notice and the demand. In the demand, imagine they are writing, because in the books of accounts it is as an expenditure, I am disallowing. Do you think that it will be justified in the tribunal or with the commissioner that is it what a reason where it is an ineligible credit? When you go to rule 42, it has to be T1, T2, T3. Now, if it is neither of this credit, on what basis an officer can disallow the credit? So my view, booking it as an expenditure wouldn't impact your credit.
This was all there, sir.
All right. Done. So if you have any questions, maybe you can unmute and ask. Else we'll move to the next part of the discussion. Again, every finance professional has to excel in their work. And when we say excel your domain and excel in the soft skills. The soft skills, we have been training more on Power BI, Power Pivots, Power Queries. We will continue the journey. Let me invite Tarun to talk about a few things, especially when you are talking about GSTR-9, you have to consolidate multiple trial balances, multiple financial statements, you have to present to the management. How one will be doing this, how one has to do. Let us start. Tarun, I would request you to start sharing your screen and explaining how we can use the technology in handling little large volume of data and presenting it.
Hello. Hello.
Yes, Tarun.
Sir,
Tarun, you are on mute. You have to unmute yourself.
hello. Sir, is it audible now, sir?
Yes, it is audible now. Yes.
Okay, sir.
Yeah.
So, can I tell this to the topic?
Yes, go ahead. Go ahead. Please go ahead.
Okay, sir. So, today I'm going to demonstrate quick
Share your
method.
screen. Your screen is not visible.
Sir, 1 minute. Sir, now is it?
1 moment. It is coming up. Yeah, perfect.
Okay, sir. And I'm going to demonstrate a quick method of consolidating trial balances of multiple companies of Tally Prime by using Excel. And now I have two companies, like two branches. We can extract trial balance by using Power Query in Excel without exporting from Tally by using Power Queries. Now I will show you that how to do. First, you have to open Tally companies or Tally branches in Tally, and we have to do settings. F1 settings. And connectivity, and we have to give local host configurations, both everything in Tally. After that, we have to move Excel. So after opening Excel, we have to go data tab and get data from here, from other source. And we have to select blank query. So it will pop up to Power Query Editor. Here, we have to click on editor option, advanced editors. Advanced editor. So here we have to paste a written Power Query. This is how Power Query looks like from language. So I will copy paste this one to Excel. And here we have to give a financial period from date to date in reverse format. And then we have to give local host number. It's like port number 9000, what I have given in Tally. You can give any port number, same as Tally, and click on done. So sorry, it's loading. It will take some time. Oh, and this is how it is extracting from Tally. Groups, opening balance, primary group, parent, name, this ledger names, everything. After this, we have to, okay, I will change this name as TV. So close and load. Here we have to load table. So like this, we can fetch our TB by using Power Query to Excel. So I will show these two companies. So like this, we can extract TB. After this, now we are going to group this TB. For this, we need another Power Query. That is group stable Power Query. So I will take that one. Go to Excel, same process. You have to go data, get data from other source, blank query, advanced editor, you have to click on advanced editor. Copy paste groups. You click OK. Sir, on junior OUPS groups.
We will, I know it's too complicated and technical glitches, but we will redo this once again for the ease of it. And we will also show how it is going to be dynamic.
Now we loaded groups and TB. So now we are going to make a pivot of TB, control pivot. This we have to take a balance. Then names into rows, and company to columns. So here we can see for every ledger there is a balances. These are all, there is nothing balance. Now we are going to merge these groups and TB into one sheet. Now we have to click on more tables, and it will ask us a new pivot table, and we have to click yes. After this, it will form a new group. Here we have to give a relationship. Nothing. TB. In this, we have to select parent. Then here we have to select group and name and click OK. Now there is a relationship between TB and group. After this, then group as nature. Now here we can see what is the ledgers related to balance sheet and P&L. Some are not grouped correctly, so it is showing blank. Then here we can take sign. Here debit is negative and credit is positive. So same way here, in balance sheet, credit and debit. Like this, we can group TB and groups into by using Power Query. Hello.
Are you done?
Yes, sir. I have done.
Okay. So now many of you have a doubt saying that, okay, whatever has been done, it looks very complicated and I really don't understand how this is done, etc. So what I have done is I have actually created a small query, blank query, and I have shown how it has to be done. I've just shared that link to you guys on the chat. Let me actually open that and show it to you as to how this is going to work. and how are we going to make use of this, and what are all the things that is done. Let me just explain to you live by taking an example. Let me share my screen. Let me do it from the fresh. So for everyone, is my screen visible? If it is visible, just put it as yes in the chat. Perfect. Now, I have shared one small link in the chat. Let me open the document. Okay, this is a document I have shared with you all. Can you guys click on that link and you'll be able to see this? Here there are a lot of things. I'll just jump to Power Query. On the left side, you can see this is a Power Query. And this is applicable to any data, anything. And this has been written in a very lucid way so that you will also be able to understand and set it. Let me start. Firstly, let me open a tally data. Don't try to analyze how everything, nothing, just follow my step. I'm opening one tally data. Let me just go to some demo thing. Okay. So I've opened, there are transaction. Let's say, is there any transaction? Oh, there are some transactions for a period. Okay, April 24 to 28 September. Is there April 23 to March 24? Okay, there are no transaction. 23, 24, there are some transactions in this data. Okay. So is the tally visible to you guys? Is the tally visible? Is the tally screen visible? Shabana says no, should be visible. If it is visible to one person, visible to everyone. Now let me open an Excel. Is the Excel screen visible? Make it normal screen as the view is not proper. I don't know. It is a normal screen. Okay. So in front of you, I have opened one Excel and I have opened one tally. Narahari sir, I don't know. It is in Zoom mode. I don't know when you say it in Zoom mode, what I really don't understand. It's a normal Excel. Okay. I am just going to the data tab. You can click on get data. There are query options. You can directly jump to a query or from file. There are various things. Okay. I am just clicking on the query options. So I am entering into a Power Query. I am entering into a Power Query mode. Okay, this Power Query editor. Okay,
From others.
launch the Power Query editor. Just above that, launch Power Query editor. In your Excel, do you all find this launch Power Query? Is it visible to you all? Launch Power Query editor, is it visible to you all? In the Excel, in Microsoft Excel of yours, were you able to see on the data, get data, launch Power Query editor? Is that option there in your Excel for everyone? Perfect. I only got one yes. Yeah. So I have just clicked on Launch Power Query Editor. I have come into this screen. In the sources, I am giving a new source. On the right top of my screen, I am just clicking a new source. From other source, I'm just hitting on a blank query. I am just taking a blank query. Okay. I can type the query here, difficult. In the home button, you can see just below the properties, there is an advanced editor. There is an advanced editor option. So which is showing as a query 1. What is the query I have to enter? Let the source be this. In my output, where do I define is this? It takes time. Over a period you will learn. Start writing small functions, you will know. I have given in the document which is given to you, you copy the data from let up until this trial balance, which I've given TBL1, 2 for various reasons I've written that. So I've did a copy and I've done a paste. So my from date, in the line number 4 and 5, I am changing the from date from 1st April 2024 to 31st March 2025. And I am just saying done. Okay, I'm just saying done. What it has done, it has brought the name, parent, all the information. It has brought the opening balance. So it has brought all the information. I am hitting and close and load. Automatically, the trial balance data has auto-populated. The trial balance data has auto-populated. So what the in the query, what Tarun has done, he has actually written, is this a debit or credit? Is it a revenue item or the P&L item? So that is what he has done. Basically, instead of we using VLOOKUP in a normal course, how do we use a VLOOKUP? If this is my parent group. This is what my ultimate parent is, and these are my primary group. In a normal course, what you will do, let's say I'll make this as my masters, and I'm just copying the unique data. So you have these many items are there. So if this is your parent, you are writing it as balance sheet or P&L. Is it asset, income, liability, expenditure? This is what you let us. There's a voice going somewhere. Is my voice echoing? Now no. All right. So I am just writing this as. I'm just doing a mapping, a simple mapping balance sheet P&L. So investment debtors, bank OD, sundry debtors, indirect expenditure is P&L. Current asset, index expenditure is P&L. P&L, fixed assets, cash, income is your P&L. Duties and taxes, sales account is your P&L. With one time that also he has done in the query. I was explaining what has happened and how he has written it. And in your let's take P&L, we can put as expense, income, and income. So if you have to say this is your grouping, I'm saying it as grouping master. So what he has actually done is using the debit credit option, he had written balance sheet or P&L, asset, income line like. So it was just a VLOOKUP of this line item in your grouping master. one formula. And he has applied a pivot to this insert pivot and finish. You can actually see your balance sheet. Let's only look at P&L and my closing balance, my assets and incomes and expenditure. So collapse entire field. So you can see the expenses under various heads, incomes under various heads. From the tally, the data has been obtained from one period to another period. Just to cross verify, let's go to my sale of computer software. Okay, there is something called sale of computer software. There is a number 34, 87, 74, 496. You can see 37, 34, 87, 74, 496. You can expand further by various ledger from sales, interstate, local sales. Let me, for just for the sake of understanding, let's recognize one more sales entry. This ledger was interstate sales. Some party, let's just, is only for the ease of it. Interstate sale. I'm just recording some 1 crore. We have recorded some 1 crore sales. Okay. Now, our interstate sales is 1 crore 60 lakhs. While you can see this is only 60 lakhs. This is only 60 lakhs, but what is there in the tally is 1 crore 60. And my total is 3587, which is there in the tally, while this is 3487. So the advantage now, this is directly integrated with the tally, same like this. So I just, if we do a refresh to my data, I hit this refresh button, you can see everything got changed. So this is where you can directly connect. Now what we have done is connection one tally data connection. So what Tarun has done, how do I loop ledger 1, ledger 2, ledger 3? We will also share you that Excel where you can also try at your end how you can get into detailed working of it. We're giving you a flavor that we want you to explore things for yourself. Yeah. This way, this is a dynamic correcting, dynamic linking. You have a present data to be presented to the management. You prepare, and this is not tagged to this tally. I can also actually write the one more query, get the tally name, one more query, the period. I can, like right now on the right side of the screen, you're seeing query 1, query 2, query 3. I can write more queries, link it, and actually make it a dynamic. So you have prepared a dashboard. Tomorrow, a different tally data comes. You just say sync and refresh. Even that gets synced, refreshed, and that gets presented. That is how one has to do it. So hope you got a fair idea. This is a journey which you have to cherish in terms of automating your presentation and getting out from your mundane work and progressing on value additive. If I have so much information, can I do month over month? Possible. Right now we've just done. What I'll tell you, only thing that is not possible is which you cannot visualize. If you visualize and say this is how I want, that is also possible. Hope I get I think everyone got a fair idea of what has been done and how it has been done. Can I use this method in any software? In any software you can use. You can use it to Oracle, you can use it to SAP, you can use it to a cloud application like QuickBooks, Zoho, you can do that. That's also possible. Can we get a document containing step-by-step process? I would want you to enjoy the journey. I have shown you, I've given you the, we have the video recording, we'll share it with you. I've given you the query, which is like cooked food. The query is with you. You can also use by yourself. Any questions to anyone? Are we clear? Can we wind up? So in the next session after the GST, we have some more interesting things to show you, especially on table 14 of GSTR-9, see how to fetch it or how to know the TDS ledger, all those things. Govind is asking, is TDL mandatory? There is no TDL in it, Govind. Nothing. It's just one Excel and the tally. You don't need to have any TDL. I don't have any TDL. Yeah. Okay, with this, we have come to an end. I thank everyone for taking your time out in learning yourself. That is what I am thanking you for. And special thanks to Hitesh and Ashika for walking us through the whole journey of getting ready for GSTR-9 and 9C. We will actually start seeing filling the data in GSTR-9 and 9C in various tables. With some examples, if you have shown in the books, not shown in 3B or shown it later, how do we do it in present it into the 9? Whole of the next session in the coming week, the journey is there. Whatever you have paid is you have paid for 2 sessions. In the next session, we will be going through with the tables. Please note, table numbers are mandatory. With the flow, we will be start talking about 5N should be matching with so and so 5P and 5Q of 9C, 4N, 4G1, which is a new table, 7J, 6J, 8D, 8E, 7E. These are the numbers will unknowingly it will start coming from our mouth. So at that point, you need to have the 9 and 9C format handy with you. That's point number 1. Second, go through the data from the portal, whichever is the data which is available in the portal, just print it and keep it. Once you log into the portal, you will get the GSTR-9 both in the PDF and Excel format. See what numbers are coming. It's easy to correlate. And then we will dwell more deeper into what are the corrections that we need to do to the data. Ashika, anything else that we need to add?
No.
Okay. Tushar is asking, is it available in older versions of Excel? Yes, I'm not talking about Excel 97. Other than that, the 2000 and above these versions, get data option is there. With this, we'll end the session further today. Thank you.